The S&P 500 flirting with a record closing high for the fourth straight day. The Dow not too far from a closing high. So neither is the NASDAQ, just about 3% off of a record high. So are stocks pricing in the best scenario right here? Let's get some more from Nick Collis. He is from DataTrek. So Nick, as I said, we got the S&P 500 at a record high. The IMF today upgrading their economic growth outlook for the year, expecting the best growth out of the world since the 1970s, out of the U.S. since the 1980s. So what does that mean for the stock market and where we are priced right here?
You know, the stock market has done a pretty good job of figuring out this trajectory of economic growth coming out of this very large depression. And so we've already seen these massive rallies off the lows and even strong performance this year. And the market's figured out two things. The first, earnings growth is going to be fantastic this year because not only do we have good economic growth, but we have a lot of operating leverage inside of companies. So we're looking for on the order of $200 a share of earnings out of the S&P by the end of Q3 and Q4 as a run rate going into 2021. The second thing the market's figured out is interest rates are going to stay low because as much liquidity as we're pumping into the system, we're not going to get the kind of sustainable inflation that would make rates go to 2.5% or 3%. And that's very good for equity valuations.
So it seems like the message we're getting from the markets lately is that every sector is going to be a winner. First, there was like this dialogue between growth versus value, but we're seeing people buy tech stocks and we're seeing people buy Home Depot.
Yeah, Home Depot is a fascinating situation because we all think of the reopening trade in the U.S. as we go out to eat, we take vacations, we fly on planes, we go to hotels. And if that's the case, why is Home Depot making a series of new highs the last week? It's really broken out. And that, I think, is the impetus for getting a lot of the growth trade back into the game in the latter part of the first quarter going into Q2, because if Home Depot is working, then we don't have to worry that a bunch of the stuff that worked last year is going to just give it up this year. You're right. Everything is working with the exception of maybe energy. Energy is still nowhere near where it was in 2017, 2018. That's been the one big laggard group.
So what do you expect for energy? I mean, if we take a look at I talked about the IMF forecast, right? If the economy is going to be booming, the best since the 1970s, the global economy, I mean, that has to bode well for oil consumption, gasoline consumption.
Yeah, absolutely true. And we're just now at the crossover point where we're going to start to see pretty dramatic growth in gasoline consumption in the U.S. And again, oil prices have rebounded nicely. The oil stocks haven't. We like energy. We like the ETFs like XLE and PSCE because we do see that recovery in oil prices and oil consumption. And that's one group that, unlike virtually any other group we can talk about, has not come back to even 2018, 2019 levels. So we do like that group. It's going to have an overhang because of all the interest in alternative energy, but over the near term, we're going to see consumption of fuel oils go back to 2019 levels by next year.
And I'm wondering, any other sectors that is catching your attention, whether it's for a breakout or a breakdown?
You know, the one sector that should work in the back half of this year is financials. That had a big lift on the value trade you discussed as rates began to rise. We're not of the camp that we can sustain 1.75% 10-year Treasury rates. We think they have to go back closer to 2% just because inflation is going to be a narrative this year and should be a narrative this year. There's something wrong if it isn't. And so against that backdrop, a steepening yield curve, financials should work as well. They are, however, back up above their old pre-pandemic highs. So the earnings expectations are pretty robust in that group, and they're going to have to see a steeper yield curve to really make them work.
So let's wrap this up with a reverse back to what we started talking about, which was earnings. So earnings season, we're on the cusp of it. When you think of earnings season and you look at the market, do you see the market as undervalued relative to what we should get from earnings? And what kind of pop do you expect to see in terms of the S&P 500?
Yeah, that's exactly the right way to frame the discussion, because what we saw earlier this year was earnings expectations from the Wall Street analysts rise every week, week in and week out, 0.5%, 1%, and that tracked the S&P very nicely. And then we had this breakout in the S&P over the last 7 days. earnings expectations have not kept up. They're flat over the last 2 weeks. So what we need from this earnings season is to basically blow the doors off the numbers, which we should, and give analysts confidence they can raise their numbers through the back half of the year and into 2022, because we are beginning to be expensive if we don't get those kind of earnings revisions to the upside. So really critical to watch this earnings season, because we need to see not only good numbers, but increasing forecasts from the analysts just to keep us where we are today.
All right, great. Thank you. That is Nick Colas of DataTrek Research. I'm Conway Gittens, and this is Reuters.